Welcome to This Explainer. Okay, today we're taking a look at the absolute hidden financial engine of the world. We hear about stock markets, inflation, and federal interest rates basically all the time. But beneath those headlines, there's actually a massive invisible network of plumbing that keeps the entire global economy running. And right now, well, that plumbing is acting up, and it's doing so in ways that have massive implications for quite literally absolutely everything. To really wrap our heads around the sheer scale of the stakes we're dealing with today, I want to ask you a pretty provocative question. What happens to the global economy when the world simply runs out of dollars? And let me be super clear here. I'm not talking about the physical, crinkled cash sitting in your wallet right now. Actually, it's more about the digital dollars, the ones that lubricate and power basically all international trade. When this massive global well starts to run dry, it doesn't just, disrupt a few banks on Wall Street. It completely shakes the entire foundation of global commerce. Okay, let's dive into this. You might actually remember that famous 1992 political campaign slogan, "It's the economy, stupid." Well, financial researchers have brilliantly adapted that phrase to describe our totally new financial reality. They argue that in a post-financial crisis world, especially a world that's seen zero or even negative interest rates, those old textbook rules, they just don't apply anymore. Now it is the quantum of money, stupid. The core idea here is that today, the absolute amount, the sheer volume of money flowing through the system matters way, way more than the actual interest rate attached to it. And the biggest volume of that money, it comes from something you might rarely ever hear about. Allow me to introduce you to the Eurodollar. Now, please, don't let the highly technical sounding name fool you into thinking this is just some boring banking term. It's a real game changer. A Eurodollar is, simply put, an unsecured US dollar deposit that's held in a bank outside of the United States. And because it exists offshore, out of the immediate jurisdiction of the US, it completely lacks the regulation and the safety nets of the federal funds market. So think of the Eurodollar not just as a currency, but as this hidden, totally unregulated engine. It is the true heartbeat of global international trade. To really understand how we arrived at our current predicament, we've got to rewind and trace the history a bit. Back in the 1950s, the Eurodollar started out as a relatively simple post-World War II payment system, largely tied to the expansion of international trade. Simple enough, right? But in 1990, a massive pivot occurred. An amendment to a banking rule known as Regulation D meant that net Eurodollar deposits suddenly had a zero reserve requirement. Zero. Banks basically didn't have to hold a safety net for these offshore deposits at all. This sparked an aggressive, wild mutation. By the late 1990s, the Eurodollar had evolved from a simple payment mechanism into this massive core funding machine for the entire global shadow banking system and all sorts of complex financial bets. And this brilliantly illustrates the sheer result of that mutation. Explosive growth. Leading up to 2008, this offshore, completely unregulated shadow banking system grew so incredibly massive that it equaled nearly 90% of the entire domestic US banking sector. No way, right? It's true. The financial world had essentially built a gargantuan offshore money machine that absolutely everyone relied upon to keep global trade moving seamlessly. But as we know all too well, what goes up in the financial world eventually faces a really harsh reckoning. Which brings us to a fundamental shift in how the world's money actually works, a really sharp contrast between the past and the present. In the pre-2009 era, before the Great Financial Crisis, dollar creation was relatively straightforward. It was mostly just a consequence of the Federal Reserve tweaking its policy rates. But in the post-2009 era, we see a sort of unintentional, systemic sabotage. In the aftermath of the crash, all these well-meaning and incredibly strict new banking regulations were rolled out globally to keep things safe. Makes sense on paper. However, these regulations aren't just moving money around. They are actively destroying dollars by slowing down the whole financial system's ability to generate enough credit. So, when the 2008 financial crisis hit, the short-term funding markets just completely froze solid, causing a massive, steep plunge in those offshore Eurodollar flows. And to make matters worse, the Federal Reserve introduced a new policy of paying interest on excess reserves, literally paying banks to just keep their money safely parked at the Fed. As a result, a massive flood of those offshore Eurodollars basically said, "We're out of here," reversed course and came pouring right back into the United States. The global pipes that funded the world were suddenly and entirely clogged up. And here's the kicker. Those global pipes are still completely clogged today. In fact, they're so clogged that it's forcing major foreign players into incredibly desperate situations. Take the Bank of Japan, for example. They've been forced to drastically increase the size of their US dollar lending program. They've even had to set up an entirely new facility specifically for lending out securities, just so the financial industry can pledge those securities as collateral to secure basic US dollar funds. Think about that. When the central bank of a massive global economy like Japan is scrambling and jumping through hoops like this just to get their hands on US dollars, it really proves just how severe this international shortage actually is. Now, what's really interesting about this slide is that the severity of the situation becomes starkly visible. Global dollar liquidity is in a rapid, severe decline, diving deep into negative territory. And the truly mind-boggling part of all this massive contraction has been happening even while the Federal Reserve expanded its own balance sheet to historic, completely unprecedented levels. The Fed has been trying to print money like crazy, but because the global plumbing is so utterly broken, those new dollars are simply not reaching the broader international system. Now, I know we've been getting pretty deep into the weeds of global banking mechanics and offshore currency flows here, so it is absolutely crucial to stop for a second and ask, why does this monetary plumbing actually matter to you? Why should you care at all about what happens in the shadowy Eurodollar market? Let's bring this right down to the ground level, to your investments, to the companies you interact with every day, and to the stability of the entire global market. So the crucial point is this enormous, honestly terrifying number, $12 trillion. That's a 12 with 12 zeros right behind it. Based on the data, that is the calculated mountain of dollar-denominated debt currently held by non-US corporates and foreign banks. Just let that sink in for a moment. $12 trillion of debt that absolutely requires US dollars to pay off. Every single day, these global corporations rely on a steady, uninterrupted flow of cheap, accessible dollars just to survive and service this massive pile of debt. When the Eurodollar engine stalls, that required cash flow just dries right up. And the historical consequence of this dried-up cash flow, it's totally devastating. The data reveals an undeniable pattern here. Whenever global dollar liquidity shrinks and the US dollar enters a bull market, meaning, dollars become super rare and highly expensive to get your hands on, global corporate defaults absolutely skyrocket. A rising dollar acts like an aggressive global interest rate hike on all that $12 trillion in debt, pushing those fragile companies right over the financial edge. Summarizing the core issue, we arrive at the ultimate constraint on our financial system today. Because of all the new safety regulations introduced post-2008, the absolute best collateral in the world, super safe sovereign bonds, is now firmly trapped on bank balance sheets. Banks are legally required to hold them, and because they are locked away in a vault, so to speak, they can't be freely traded to create liquid cash. This brings the process of what we call rehypothecation, which, by the way, is basically the financial system's ability to lend out the exact same dollar multiple times to grease the wheels of trade, to an absolute crawl. The sheer velocity of money has been fundamentally throttled, pretty much ensuring that this massive dollar shortage is going to persist. Which leaves us with a truly vital question to ponder as we close out today's explainer. As the gears of the Eurodollar system grind slower and slower, and the world's reserve currency becomes impossibly scarce, which global corporations will actually survive the coming squeeze? I mean, we are looking at a ticking time bomb of $12 trillion in corporate debt, in a world that is actively, desperately starving for dollars. It's a stark economic reality that will absolutely shape the years to come. Thank you so much for joining me to unpack all this fascinating data today, and I look forward to exploring our next topic with you very soon.